Hello everyone, Mike here. This video describes the accounting treatment of deferred revenue, a significant liability reported on the balance sheets of many Silicon Valley companies. Before describing how we treat deferred revenue for these companies, however, let's briefly review the accounting treatment for deferred revenue in general. Deferred revenue, which is also known as unearned revenue, refers to payments received by a company for services that have not yet been performed or goods that have not yet been delivered. Since the company has not yet earned these revenues, the advance payments are not yet recognized as revenue in the income statement. Instead, these payments are reported on the balance sheet as a liability. When the service is later provided to the customer, the deferred revenue is recognized on the income statement as earned revenue. Examples of items requiring deferred revenue treatment include advance ticket sales for entertainment, sporting events, or airline travel, gift card sales, magazine or online subscriptions, extended warranties, and advance payments for leasing or insurance services. To see how some Silicon Valley companies are affected by the accounting treatment for deferred revenues, we'll begin with Salesforce.com. Salesforce derives the bulk of their revenues from subscription fees for their services. These fees are typically paid before or within the first month of the contract, which can last between 12 and 36 months. According to Note 1 in their financial report, Salesforce subscription and support revenue is recognized ratably over the term of the contract. Salesforce reports the deferred revenue on these advance payments in the liability section of the balance sheet. As of January 2017, the company reported $5.5 billion of deferred revenue as a current liability and $37 million as a non-current liability. Deferred revenue is its largest liability, dwarfing its accounts payable and debt, and exceeds 70% of the revenue that it actually recognized for the year. Interestingly, the year-over-year growth rate for deferred revenue for its fiscal year January 2017 exceeded the growth rate for subscription and support revenue recognized during the year, which bodes well for Salesforce's future. Next, let's look at Intuitive Surgical for another example of deferred revenue. Intuitive Surgical sells Da Vinci surgical systems and related instruments and accessories. The surgical system that they sell is composed of many elements, including the system itself, accessories, instruments, and technical support. According to Note 1 in its financial statements, the system sales arrangement typically includes 1 year of free service, as well as 4 additional years of service that is billed at the beginning of each of those years. Since the customer purchases 1 year of free technical service when the system is installed, that is, before the technical service is provided, the value of this future service is recorded in the balance sheet as deferred revenue. As of 12/31/16, Intuitive owed its customers about $240 million of technical support services. According to Note 1, the deferred service revenue is recognized ratably over the free service period. When the customer renews the technical support contract at the beginning of each subsequent year, the company again records deferred revenue for the value of the service contract. The renewed contract revenue will then be recognized ratably over the remaining service period. Because Intuitive Surgical charges a single price for the entire system, how does it determine the value of the revenue attributable to the future service? We know the value of the system's support is not free because the customer actually pays for the service when it purchases the system. To allocate the value of a multi-element sales arrangement, like the sale of a Da Vinci surgical system, among the different elements, like the system itself, the accessories, the instruments, and the technical support, the company must first determine the standalone value of each element, including the standalone value of 1 year of product support services. This can be difficult because many of the elements in the sales arrangement are not separately priced. Once it establishes the standalone value of each element of the contract, the company then allocates the value of the system to each element based on its relative standalone selling value. Determining the value of each element in a multi-element sales arrangement can be quite complex, and it's certainly beyond the scope of this course. However, it's important for you to understand that this exercise must be done whenever a revenue transaction requires a company to provide any future services to the customer. The final company we will discuss in this video is Oracle. Oracle derives its revenue from many sources, including cloud, software, hardware, consulting, and support services. Its largest revenue source in fiscal year May 17 is from the sale of software licenses and product support. By now, you should not be surprised to learn that the vast majority of Oracle's software license sales arrangements require it to provide future services in the form of software updates and product support. The revenue from these services are recognized ratably over the term of the license, which is typically 1 year. In Note 1 to its financial statements, Oracle clarifies that these updates can include software product updates, maintenance releases, and patches, while the product support includes internet access to technical instructions, as well as access to technical support personnel. The value of these future services is recorded, again, as deferred revenue in the liability section of the balance sheet. Aside from borrowings, deferred revenue is Oracle's largest liability. Since Oracle offers many types of products and services, Note 10 in its financial report provides additional detail to investors about its deferred revenue. For example, similar to Salesforce, Note 10 states that deferred revenue from its cloud-based subscription services is recognized pro rata over the term of the contract. On the other hand, advanced payments received on consulting or education services are generally recognized as the services are provided. Oracle's largest source of deferred revenue relates to software license updates and product support. Similar to Intuitive Surgical, deferred revenue from these contracts are recognized ratably over the support periods. So let's summarize what we've learned. Once again, we've seen that revenue accounting in Silicon Valley can be quite complex. Sales of products and services often involve multiple element arrangements, which requires the sales price to be allocated to each element of the contract. We saw that revenue allocable to subscription contracts, like in Salesforce, technical support, as in Intuitive Surgical, and license updates, as in Oracle, and other future services is initially recorded as deferred revenue. The deferred revenue is then recognized in the income statement as the service is provided to the customer. Well, thanks again for joining me, and stay tuned for more videos involving financial reporting topics involving Silicon Valley companies.